Reuters reported that only a handful of ships passed through the Strait of Hormuz in a recent 24-hour period versus a much higher pre-war daily average, showing traffic disruption remains serious. The IEA says the strait carried nearly 15 million barrels per day of crude in 2025, around a third of global crude oil trade, while EIA data shows total oil flows through the strait were about one-fifth of global petroleum liquids consumption in 2024. The IEA's April oil report says the Iran war has sharply changed its oil demand outlook, and the IMF says the de facto closure and infrastructure damage made energy the main transmission channel for global economic stress. The silver market layer was checked against Silver Institute material, showing large global silver demand and a sizable deficit backdrop. Well, there's been a lot of talk lately about the Strait of Hormuz, the Iran war moving into another month, and whether gold and silver are about to get hit first before they move higher. So in this video, we're going to separate the scary headline from the actual market setup, and you are going to walk away with a much cleaner idea of what matters, what does not matter, and where the real risk is hiding. Today is Saturday, April 25th, New York time. Drop a comment with the day and date you are watching from, because I want to see how quickly this story changes by the time this reaches you. And if you value this kind of breakdown, support the channel by subscribing and comment John AG Best below. Simple, quick, and it tells me you want more of this work. So in case you have not been following every twist here, the basic story is this. The Strait of Hormuz is not just another headline. It is one of the main pressure valves of the global oil system. When traffic through that corridor gets disrupted, the oil market does not just shrug. Shipping companies pause. Insurers raise prices. Refiners worry about feedstock. Importing countries start doing math very quickly. And that is why the latest signal matters. The clue was not just that the conflict is still unresolved. We already knew that. The clue was the tone coming from the military side. When a defense official starts warning about more severe strikes, markets hear something very different than ordinary diplomatic noise. They hear duration, they hear retaliation risk, they hear shipping delays, they hear oil supply risk that does not vanish because somebody says the word ceasefire. Now, does that mean we wake up tomorrow and gold explodes, silver goes vertical, oil goes crazy, and every investor suddenly understands the whole picture? Not necessarily. And this is where people keep getting it wrong. Markets do not always respond to danger in the way your common sense says they should. Sometimes the first reaction to a bullish long-term metals story is an ugly short-term metals sell-off. It sounds backwards, but it happens all the time. Let me show you what I mean. If the strait remains disrupted, the first obvious channel is oil. Energy is the tax that touches almost everything. It touches freight. It touches plastics. It touches fertilizer. It touches airline fuel. It touches household budgets, and when energy jumps quickly, businesses either absorb the cost, pass the cost along, or cut something else to survive. That is inflationary, but it is also growth negative. So gold and silver get caught between two forces. On one side, higher oil can make people worry about inflation, and metals are supposed to protect against that. On the other side, higher oil can slow the economy, create margin stress, and trigger forced selling. In that first wave, people often sell what they can sell, not what they should sell. That is why the short-term answer and the long-term answer cannot be the same answer. If you are trading this, flipping positions, trying to catch a move over a few days, then you have to respect the downside risk. A military headline can push oil higher, scare equities, tighten credit, strengthen the dollar for a moment, and still knock metals lower. That does not mean gold stopped being gold or silver stopped being silver. It means the first phase of a crisis is usually about liquidity. Then the second phase is about meaning, and those are not the same thing. Think back to the early pandemic period. At first, a lot of markets treated the problem like it was isolated, temporary, and maybe manageable. Then suddenly the same story became the whole story. Travel froze, demand collapsed, central banks panicked, governments spent. Gold and silver did not price that entire sequence in one calm move. They moved in waves. That is a better way to think about this setup. Not identical. Nothing is identical, but similar in structure. First denial, then confusion, then forced selling, then policy response. Then hard assets begin to make sense again to people who ignored them the week before. So if you are a long-term stacker, step back for a second. The metal itself did not change this morning. An ounce is still an ounce. The coin in your hand is not becoming more or less real every time a news alert hits your phone. What changes is the currency around it, the debt around it, the oil price around it, and the policy response around it. And right now, that backdrop is not getting cleaner. We have a war that is stretching longer than markets wanted. We have a choke point that is still not behaving normally. We have oil risk feeding cost pressure. We have growth risk building underneath the surface. We have governments already carrying heavy debt loads. And we have central banks stuck between inflation that does not fully disappear and growth that cannot take much more pressure. That is not a clean inflation story. It is not a clean recession story. It is something messier. And messy is exactly where gold and silver usually become more important over time, even if they get slapped around in the beginning. Now let us be fair. This is not a one-way argument. If oil gets too high and global demand breaks, silver can get hit harder than gold because silver is partly an industrial metal. Solar, electronics, autos, electrical equipment, medical uses, all of that matters. If factories slow down, investors may worry that industrial demand is softening. That can weigh on silver. So the silver bull case is not immune to growth pain. That is the counterpoint. But at the same time, the silver market has already been tight. Industrial demand has been strong. Solar demand has been a major part of the story. Supply has not been magically expanding fast enough to make every problem disappear. And when a market is tight before the shock does not need to be perfect to matter. This is why silver can act so strange. It can fall when the long-term story is improving. It can rally when people were sure demand was weakening. It can ignore a bullish headline one day, then explode weeks later after the broader market finally understands the implications. So do not confuse the destination with the road. The road can be ugly. Now, if you are looking at miners, that is another layer. Higher gold and silver prices can be very good for producers, but mining stocks are not metal. They are businesses. They have labor costs, fuel costs, permits, debt, management teams, political risk, financing risk, and sometimes a very special talent for disappointing shareholders at exactly the wrong moment. So yes, a strong metals price can improve margins. It can make drilling easier to justify. It can revive projects that looked boring when prices were lower. But do not just look at silver and assume every miner wins equally. That is not how this works. The same environment that helps revenue can also raise costs. Fuel costs rise, equipment costs rise, financing gets harder, governments sometimes want a bigger slice. That is why miner selection matters more in a volatile cycle than it does in a calm one. And this cycle is not calm. Now, what about the idea that a deal could suddenly appear? Sure, it could. Geopolitics can change fast. A statement can soften. A back channel can open. A ship can move. A headline can make everyone believe the worst is over. I'm not saying a resolution is impossible. I am saying it does not look like the highest probability base case right now. If a real deal arrives and shipping normalizes, oil could cool down, inflation fears could ease, and metals could face a different kind of pressure. That is the scenario bulls need to respect. You do not build a serious plan by only studying the outcome you prefer. But if the strait remains impaired, then the chain is fairly straightforward. Oil risk stays elevated. Higher energy keeps cost pressure alive. Cost pressure keeps inflation sticky. Sticky inflation limits central bank flexibility. Slower growth increases pressure for stimulus. And stimulus, debt expansion, and currency dilution keep the long-term case for gold and silver alive. See, that is the loop. And once you see the loop, the daily candles become less confusing. A red day does not automatically destroy the thesis. A green day does not automatically prove it. What matters is whether the underlying loop is strengthening or weakening. Right now, I would argue the loop is still strengthening, but the timing is dangerous. That means position sizing matters. This is where traders get into trouble. They hear a big story and they size the trade like the market has to agree immediately. It does not. The market can be wrong longer than your margin account can breathe. And even when the market is starting to get it right, it can take the most painful route possible. So if you are short-term, be careful. Watch for further downside. Watch the dollar. Watch oil. Watch shipping traffic. Watch whether gold behaves like a safe haven or like a source of cash. Watch silver's ratio to gold, because if silver weakens faster, the market may be pricing growth stress more than inflation fear. If you are long-term, the question is different. Can you hold through volatility without needing to sell at the worst moment? Do you have cash outside your metals? Are you buying because you understand the thesis or because you saw a dramatic thumbnail? Would you still be comfortable if price dropped before it rose? Those questions matter more than someone else's price target. And please remember this. Nobody should root for a war or a closed shipping lane just because they own gold or silver. That is not investing. That is moral confusion. Real people get hurt. Real supply chains break. Real households pay more. The goal is not chaos. The goal is to understand what chaos does to markets when it arrives anyway. If you're successful, share your success story in the comments so others can stay motivated. And tell me this in the comments. Do you think the market is underpricing the straight risk right now? Or do you think traders are correct to worry more about growth damage than inflation? I want to see where people stand, because this is one of those moments where two smart investors can look at the same headline and walk away with opposite trades. There is another piece here that almost nobody talks about enough. The physical market and the paper market do not always move together at the same speed. Paper traders can change exposure in seconds. A physical buyer cannot instantly rebuild shipping routes, refinery schedules, warehouse flows, or industrial procurement plans. So when disruption hits, the futures screen may look calm for a few hours, while the real world is already getting tighter behind the scenes. That gap matters. If shipping companies are nervous, the cost is not just the barrel of oil. It is the insurance. It is the delay. It is the crew risk. It is the rerouting. It is the missed delivery window. It is the manufacturer waiting on inputs. Those costs do not always show up in one clean chart, but they eventually show up somewhere. And when they show up, policymakers usually act surprised. They will say the shock is temporary. They will say the consumer is resilient. They will say supply chains are adjusting. Maybe some of that is true. But if prices stay high long enough, behavior changes. Families cut back. Businesses delay investment. Governments start talking about relief. Central banks start talking carefully. And then the market begins asking the dangerous question: who pays for all of this? That is where metals enter the conversation again. Not because gold and silver fix the problem, they do not. A coin does not produce oil. A bar does not reopen a shipping lane. But metals sit outside the promise chain. They are not someone else's liability. And in a world where every answer seems to require more debt, more guarantees, more emergency spending, and more confidence, that difference starts to matter. Now, could the market ignore that for weeks? Absolutely. Could silver get shaken out before the stronger move? Absolutely. Could gold look boring right before it becomes important again? Yes, and that has happened many times. So the key is not to predict the exact candle. The key is to avoid being emotionally forced out of a thesis you actually understand, while also avoiding the arrogance of thinking the thesis protects you from short-term pain. That balance is everything. That is exactly where discipline earns its keep right now. So, putting it all together, I do not see a clean, easy resolution as the base case. I hope one comes, but hope is not a strategy. The more realistic setup is continued uncertainty, jumpy oil, nervous shipping, pressure on growth, pressure on prices, and a policy response that probably gets bigger if the pain spreads. For gold and silver, that means short-term risk and long-term support can exist at the same time. That is the whole puzzle. Short-term, liquidity matters. Long-term, credibility matters. And the longer this conflict drags on, the more the conversation shifts from what gold and silver do tomorrow to what they protect you from over the next several years. One more thing. If the market gives you a lower price, do not automatically treat it as a gift, and do not automatically treat it as a warning. Ask why it happened. Was it forced selling? Was it demand destruction? Was it a stronger dollar? Was it margin stress? The same red candle can mean completely different things depending on the cause. That is why context matters more than emotion here. Metals investors who survive long cycles are usually not the loudest people in the room. They are the ones who stay flexible, stay liquid, and keep thinking when everyone else is performing for attention. So keep your head clear. Do not chase panic. Do not marry one headline. Do not size a position like you know exactly what happens next, because you do not, and neither do I. What we can do is watch the pressure points, respect the downside, and understand why the deeper thesis has not gone away. In fact, it may be getting stronger, but stronger does not mean smoother. And that is the part that separates serious investors from people just reacting to noise. This is for education and market discussion only, not personal financial advice. Make your own decisions, know your own risk, and never let a dramatic headline make a decision that your calmer self would not approve.